right, here we go. All right, there he goes. Mike Smith. Tonight he's going to be talking about volume analysis. Mike Smith and I have become really good friends. He is affiliated with HawkeyeTraders.com. Nigel Hawks owns that company, and Mike is very proficient in options and also using their volume analysis setups. And so I've heard him speak several times, and we decided to invite him here tonight to give you his take on how to use volume, which if you go back and study, you'll find that volume is one of the most powerful indicators that you can use when you're trading in the markets. So I'm going to go ahead, and if you give me just a second, I'll make Mike the presenter and the organizer. He will have 1 hour, and then we will round tonight out with John Seville from Acorn Wealth. And let's make him organizer. So Mike, if you want to give me an audio test, and y'all just have to recognize Mike is from way across the pond, and so his sound can sometimes go in and out, but we are recording, and we'll get a good recording on my end, and if we don't, we'll work out him doing a redo for us. But go ahead, Mike, you talk for a second. Let's see how our sound is.
Hey, thanks, Jeanette, and welcome everybody. Delighted that you could all make it tonight in the time zone that most of you are in this morning. For some of you on this side of the planet, can you hear me well? Can you?
The sound is great. Sound is great. Okay? You have 1 hour.
Fantastic. Well, guys, look, delighted that you could make it. And as I said, it's a pleasure and a privilege, as always, to get the opportunity to share some of my experiences with anybody who's interested in trading. We're all traders here. And as Jeanette said, I do some work for Hawkeye Traders. And what Hawkeye Traders Trading Edge is that it uses volume spread analysis as a basis for trading decisions. So I'm going to just briefly go into a little bit of that. I'm going to talk generally about what makes a good options trader as well. And then I've got a couple of things to share, which I think will be of great interest to you. It would be fantastic if you could start the ball rolling by participating your end, by just letting me know where you guys are in terms of options trading to date. Are you experienced option traders? Type in experience, or are you new? Then type in new, or are you sort of somewhere in between where you're just learning the ropes, have a little bit of experience? So if you wouldn't mind just typing on in there, that'll just give me an idea about who I'm talking to a little better, just so I can make sure that I pitch it well so everybody can walk away with something of value over the next hour. That's perfect. Okay, we've got a real mix, some new, some intermediate, some learning, some very experienced traders, and some who've had a go and trying to get back on the options saddle. That's superb, guys. Thank you so much for participating. It's always nice to get some feedback. It's a very strange educational medium, this, for in many ways. I do like live events because I can see the whites of your eyes, see who's getting it, see who's not getting it, but I rely on your participation to make sure that I give you something that's useful. So keep it up, guys. That's superb. Thank you. Anyway, let's get on with the session in earnest. As Jeanette said, I'm the options specialist for Hawkeye Traders, and just a little bit about me. It's your webinar, so I'm not going to bang on about this for ages about how I've done this and I've done that. It's 20 years a trader, and over the last decade, I've been a consultant, coach, and teacher. Primarily, my instrument of choice has been options, though I have done and do trade occasionally vehicles and also do some equities trading, not surprisingly. Worked with Hawkeye Traders for a little over 2 years now. Nigel came over to Australia, where I now live, was brought and born and lived most of my life in the UK. Moved over to Perth in Western Australia, which is a wonderful part of the world, and why I'm on probably 12 hours ahead of most of you guys in the morning. And he came over here and saw me speak at the Australian Technical Analysis Association. Wanted to add options to an already vast and very successful portfolio of vehicles that Hawkeye Traders is used for. They've already got Forex and futures and equities in place, and wanted an options arm. And so that's where we met. And from then, we've we've developed a service which we're really quite proud of. So what we run is a Trade Alert portfolio education service, which isn't really the topic for today, but just to let you know what we do at Hawkeye Options. And we had a very successful year one, which was that 250%, which was the title, and based on, as Jeanette's already indicated, as the title of the talk is, on volume spread analysis. So as a teacher, I'm passionate about seeing other people get results, and please feel free to make a note of the email address there. More than happy to field any questions after the event if I don't get a chance to answer them on the event, or any other queries you've got about options or trading in general. So when we look at trading success, the bottom line is these things. Much energy and effort is put on entry. Okay, lots and lots of indicators are very sexy, and we have lots of nice colors on the chart, but really the purpose of entry is only to find trades that have a high probability of going in your direction for a period of time. It's not entry that necessarily determines profit, and what really counts is two other things. First of all, it's what you do next, i.e. what you do in terms of having timely exit strategies. And secondly, and I'm going to make reference to this as we go along because this is an integral part of what we teach, is matching strategy to market. And there aren't many out there doing it. Now, there's lots of people teaching credit spreads and calls and strategy A, B, and C, but there are specific market conditions which should knock these strategies off and enable them to be switched back on again. And so it's those three things: high probability entries, timely exits, and matching strategy to market. And so that's what created that 250%. Now we're about 90% this year. A very, very different market this year to last year. But that year to date, we're around about 90% in the Hawkeye Options portfolio. But if we looked at that 250% and 55 directional trades were traded during that time, our win-to-loss ratio was 28-27, so a 1-to-1 win-to-loss ratio. So win-to-loss ratio is not the most important metric for directional trading. What is the most important metric is your average win versus your average loss. Now, I know it's an old market cliche that keep your losses small, let your profits run, but we had an average win of 64%, our average loss is 21%. That's what created that number. This year, it's not been a directional market. We spent the first 8 months or so in congestion, trading within a very tight range, one that hasn't been seen for that length of time for in excess of 100 years in equity markets. And so directional trading was far more difficult. So we switched on a couple of diagonal call spreads to take advantage of that, and then traded directionally when there was an opportunity to do so. Obviously, we had then the subsequent correction, and since then we've had a pullback, and we're back in that range again that we've been in for most of the year. Now, having said that, win-loss ratio is not important in directional trades. Some other types of trading, and make a note of this if you are interested in the weekly credit spreads, win-loss ratio is absolutely vital if you're trading credit spreads. You get a poor win-loss ratio, or a win-loss ratio of 1-to-1 with credit spreads, and you're not going to do very well. You're going to see your account hemorrhaging dollars, and you're not going to be in the market for very long. So hence it's different setups, and I'm going to show you one of the things that we use, because I know many of you are interested in weekly options, to enable you to get those high probability entries, that higher win-loss ratio, which is so important. Later on in the session. So as I've said, and I want to reinforce this because it is the difference, having coached many people over the years, it is the difference between those who consistently get great results and those who wish they did, okay, is that they spend an awful lot of energy finding a way to match their particular group of strategies that they trade to specific market conditions. There is no one strategy that can work in every market. That's why most trading robots blow people's accounts up over a period of time, because there's no switch off. There's no, right, this market doesn't suit this particular system. It is a skill you must learn. The nice thing about options, and one of the advantages, is you have a range of strategies at your disposal. You've not just got up and down. You've got up and down and sideways, and you can put things away from the action, you can put things at the action, you can put things long term, you can put things short term, and that's one of the appeals to me and many option traders, is that flexibility of choice of strategy. It's like, to use a metaphor, it's like going to the golf course with, you wouldn't go with a putter or a driver, you would actually go with a whole bag of clubs and pick the one that's appropriate for the conditions that are prevailing, as well as the actual what's happening on the particular hole itself. So that's absolutely crucial. So let's just take a step back and talk a little bit about what volume spread analysis is, or VSA, which we call it. So one of the issues that we have is that most of the proprietary indicators that we use are lagging. So what Nigel did is spent an inordinate amount of years putting Hawkeye together and using volume spread analysis, which really looks at what's happening in volume and its relationship to price. The simple fact is, to analyze a chart, and so what you're seeing is supply demand for a particular asset class. It doesn't matter whether you're trading equities or options or forex or futures, the rules of the game are the same. If you want to see supply demand in the market, then you look at volume. Now, volume may be buying or selling volume, and the way, or one of the ways to do this, and it's a very complicated algorithm that Hawkeye uses, is it looks at what the price bar has done on that volume and where it's finished up. Has it moved up? Has it gone down? Has it gone sideways intraday? And then comparing that against what's happened previously. And by doing this, and by looking at what's happening to volume and trend, we create a trading edge using volume spread analysis, which is primarily leading. We often see volume change before we see a trend change, or before we can have confirmation that a trend is going to continue. And that's why volume is considered to be a leading indicator. And as I said before, VSA is used across all vehicles. So I just picked a random chart before we started, just because obviously the markets have closed. So I just picked Microsoft just to give you a something real and something current to have a look at. So what we see here, just to explain what a Hawkeye chart looks like, is that we've got the trend, which may be up green, in congestion, which is white, or downtrend, which is red, and we've got the volume along the bottom, which not only shows the level of volume, but also shows whether that's buying volume, indicated by green, neutral volume, which is indicated by white, and selling volume, which is indicated by red. So what we're looking for is, when to give ourselves an edge and to have our fingers on the buttons for a potential entry, is to find positions that volume may be changing, that may indicate the start of a new trend. So let's just take an example here. If we see this downtrend here that was in place during June and July in Microsoft, then what we see here is we see buying volume coming in before the trend changes. So Microsoft was on our radar at this point for a potential, as I said, right, probability entries, and there's no guarantee of how long a particular trend may last. So that's when your exit strategies come in. So if we entered on this bar here, we would potentially see the pivots that were in place there and probably take it off 2 or 3 days later. If we look here, we had really a period of congestion, and there you see again, you see the green volume coming in, and of course there's the confirmation of green trend. It actually broke through those pivots. Nice entry there. And of course, up it went. We would have exited this at this point simply because this is an earnings jump. So we exit pre-earnings, obviously one of the rules of the game. We may have exited earlier somewhere around here. But that'll be a $1.50 jump up, which in terms is going to be pretty impressive. It's going to be about an 80 or 90% return. So that is the key factor with volume spread analysis. You can see that leading indicator coming in. You can see the volume or the type of volume changing prior to the trend move. And of course, it works the other way as well. We see here Microsoft in congestion. We saw the selling volume in. That's something that says, hey, look, we could be in for a selling session here. We would obviously use these pivots here, and so our entry on this would have been on this bar here as it changes trend, as it breaks through the pivots on red volume, and we would take advantage of this move down. So really that's what volume spread analysis is all about. It's about studying volume, it's about knowing whether that volume is buying or selling, and it's about having things on your radar which you can be at the front of the queue when trend changes, not at the back of the queue, not the person who's buying at this point here or this point here. And that's crucial. Now, the other thing, just to point out in this chart, I'm going to make reference to this here. You'll see these purple bars. These are called wide bars. I'm going to talk about these in a little more detail in relation to, just let me know how many of you trade weekly options or are interested in trading weekly options. If you could just pop in the questions there, which I'm going to have a look at in a moment. How many of you are actually interested or already trading weekly options, usually credit spreads? Eugene, I see you're doing credit spreads and iron condors. That's good. How's the audio going, guys? Has that improved at all? Oh, lots of people interested in weekly options. There's a couple of people having.
Yeah, that sounds a lot better to me. That sounds like really good, Mike. Really, really, really
okay.
good.
That's good. I just saw a few comments coming in.
Yeah, and everybody just recognized he's in Australia, and sometimes it's going to get spotty. And I've heard him speak so many times. It starts getting spotty. It eventually sort of corrects itself. So you just got to hold on. Go ahead, Mike.
Thanks, guys, for the feedback. It's always useful. I really appreciate that. Okay, so we've got quite a lot of credit spreads and weekly traders, and perfect. Okay. I will try and speak just a little bit slower, Steve. I do recognize my accent is probably unusual to a few of you as well. So, look, as I said, these purple bars, these wide bars, we're going to talk about in a moment because these are really relevant to potentially to those of you trading weekly options. They're absolutely incredibly powerful. So one of the other things that really is a part of the rules, and in terms of volume spread analysis, or the type of volume spread analysis we use, is we don't just trade on one time frame. So we make our decisions based on seeing buying volume across multiple time frames. Now, just to give you an example, so we use 3 charts. For directional or short-term trading, such as weekly sort of credit spread trading, we use the 1-day, 2-day, 1-week combination. So look at a 1-day chart, 2-day chart, 1-week chart. And for longer term spread positions, so we've got 2 diagonal call spread positions. Open at the moment, we would use a daily, weekly, monthly, or if we tend to hold a bull call for a long time, we would also use that. Okay, question on what a diagonal call spread is. Let me just give you a quick rundown because this is, if you're doing covered calls, it's essentially like that. So, excuse the drawing with a mouse, I'll just do my best. So normally a covered call is you buy shares, for the medium long term, and then you sell calls over the top on a weekly or monthly basis for as long as the underlying share says stay in, and you generate dollars from selling calls on a regular basis. And if you're holding equities, I'm not sure why you're not doing this if you're not doing it. And also, so that does two things. Okay, now it allows you to profit from the movement of the underlying share, or it allows you to profit because you're bringing in monthly premium or weekly premium. Now, the problem with this is that cover calls are relatively expensive. You're buying a reasonable number of shares. Let's say you're to buy 10 contracts of Microsoft. It's going to cost you a bob or two. Okay, it's cost you quite a lot of cash. Whereas if we use a longer term bought call, so say 6 to 9 months out, we could probably pick that up for around about $4 or $5 a share if we were to put it in the money, rather than what we're paying for Microsoft already. So around about a tenth of the price for exactly the same premium that's coming in. It's risk capped, unlike a share. So that's really the essence of a diagonal call spread. And as I said, it's one of the things that that you'll see in the Hawkeye Options Trade Alert and Portfolio Service. We always have at least a couple of those going. At the moment, we've got one in FXI, which is a Chinese ETF, and one in GE. The FXI has been an interesting ride, but we've had that since February. It cost us around about $6,000 to get 10 contracts in, but it's about 2,000 up in terms of, and that's despite what's happening in China. So why, one of the things, or one of the reasons I've mentioned that is that if you are selling options over stock or long-term calls, or you really need to master when and how you sell a call over the top. But consider that if you're just trading equities now, how good would it be to get the to get exposure and the ability to sell calls over the top for around about a tenth of the cost. Now I'm going to show you something. I'm going to mention something phenomenally spectacular that I'm guessing 98% of you won't have heard about before tonight in a little while. Just hold on with that one. Now, okay, back to the, let's just erase the drawings. So, multiple time frames, what do we mean by that? Let's just show you an example with something that we're in now. Again, let's keep it real. Enter this on continuation of a trend, okay? So we were looking for a new trend or a continuation of a trend. We saw the new trend come in here, but we weren't that keen to jump up and down. You'll see there we had some pivot highs previously when the new trend came in at around about 24.40. So we actually entered on this bar here, and of course we've taken advantage of that. So if we look at our 3 time frames, if we look at our 1 day, you'll see there's the green volume coming in. We look at our 2 day, there again with the green volume coming in. Weekly coming in again. So we've got all 3 time frames that this trend likely has a high it just hurts it a little bit. Okay, so just to refresh that. So we've got buying volume on JBL on the daily chart. We've got buying volume, and we're looking at 3 days ago. So you see the green volume coming in 4 days ago. We've got buying volume on the 2 day, and we've got buying volume on the weekly. And that's despite quite a lot of market uncertainty going on. Okay. So what we've got next is really what about strategy selection? Trading against the market is very tough. You do that, you've got to be on top of the market and on top of the market all the time. So we trade with the market. And also with options trading, volatility is often the key to selection. So if we use quite simply, the S&P 500 and the VIX, amongst other things, but let's start with the simple that is easy to get, easy to see. This will give us huge clues as to which strategies may be suitable for the market at any one time. Okay, so if we start by looking at the S&P 500. So at the moment, there's our, we have this period, as I said, up until August, which was really trading within a very tight range. Directional trading was very tough. That's when we have the diagonal call spreads working well for us. We occasionally directional traded just to take advantage of those short-term moves, but it was looking at scalping rather than longer-term directional holds. Of course, since October, we've had a great run, and that was the ideal time because we had this uptrend on the S&P 500. You'll see on the VIX, we saw the VIX drop back into downtrend, and we had buying volume on the index as a whole. So if we have for every strategy, if we have a situation which says if the S&P 500 is doing this, if the VIX is doing this, then that gives us, even if you just had those two basic things in place, that would enable you more successfully to match strategy to market. The one thing about the VIX is, of course, the VIX measures implied volatility on options. Now, for those of you doing credit spreads and weekly options particularly, this is vitally important. It's not been a great credit spread market. Quite simply because, generally speaking, volatility has been low. So, again, by looking at these two things, we can decide which ones to switch on, which ones to switch off. Now, for those of you moving forward, there is something that we want you to have a look at. Then we're going to go into this in a lot more detail in matching strategy to market because, as I said, it's absolutely crucial that you start to look at this as part of your decision-making processes. So what I want to do is just talk a little bit more about credit spreads. And again, I'm just going to give those of you less experienced just a very quick tutorial. So credit spreads are best placed in the market where some uncertainty exists. And you can see this in the VIX, generally speaking. What we're doing is there's two sorts of risk that we trade, because that's what we trade. When we're trading, we trade risk. Okay, so the first type of risk that we trade is the dollar risk. Now, with something like directional trading, really once an underlying position moves in the opposite direction by 1 cent, we're usually worse off. We're usually in a losing position. Okay. Now, obviously, we give ourselves a little scope for it to bounce up and down, take out the noise, but we'd still have a stop there usually. The other sort of risk that we're trading is the likelihood of a risk event occurring. So with things like credit spreads, what we're doing is we're taking the likelihood of a risk event occurring, i.e. a loss, away from the action. So if we think that Microsoft will go up from here, we could place a credit spread underneath where the current price is, so the underlying stock can profit from a move up, a move sideways, or even a move down, and often quite a way down, ideally, before we're in a loss situation, before the underlying share price starts to breach the upper strike price of the option leg. So we could trade a bull put spread if the current price below the current price action, or a bear call spread above the current price action, depending on which way we think the market's going to go. And what we're doing really is we're taking advantage of the premium that's available in terms of time value that's left in an option. Of course, this decreases more rapidly as it gets closer to expiring. Now, that's what people selling credit spreads will sell it on, okay? But the fact is, the absolute indisputable fact is that the major impact on option pricing is the movement of the underlying share. So you can have the best spread or the best premium in the world, but that premium that you attained for your credit spread initially might disappear completely and be in a fairly dramatic dollar loss situation if you haven't positioned well, if you haven't taken into account the underlying market conditions. So if a credit spread goes wrong and you don't have a timely exit, then it can hurt. So there's a few things that we do around this. First of all, we do a short duration. Okay. Secondly, just to reinforce this, it's not ideal in every market. What we're looking for, ideally, is relatively high volatility that is dropping. So the best time to place a credit spread, particularly bull put spreads, is when we've had a major market drop. We see the market, as we've had a few times, see a drop of 5 to 10%, we see it bouncing back up again, and then subsequently we can place our spread well away from the action, get a nice premium for it, and reduce the chance of that risk event occurring significantly. We may also see potential opportunities immediately after earnings. So theoretically, that would be our ideal credit spread setup. And really, you guys who are trading credit spreads should have a trading plan that reflects that and should be monitoring these particular things, including volatility. But there is one more thing, and I'll take you back to the Microsoft chart. Okay, and back to this purple bar. Okay, so this purple bar, as I said, is called a wide bar. Now, you don't have to have Hawkeye to get this concept. And one of the things we're going to do for those of you who are going to move forward is we're going to show you how to identify a similar situation using the standard indicators that you all have access to, that are free, that are available on any site at all. Okay, the Y bar just makes it slightly easier because it's there, right, bang smack in your face. So what a wide bar is it's an intraday move which is of higher than normal volatility, and this creates an opportunity for credit spreads. Now, traditionally wide bars we look at because we say, well, look, if we see a wide bar movement, that's unusual price action, and so let's see if we want to go long, let's see if it breaks the top of that wide bar before we enter it. Okay, but with credit spreads, what we're doing is we're using the wide bar to say, well, look, this is a period of high intraday volatility. Let's take advantage of that and the position of the wide bar to place a high probability credit spread trade. Okay, so the basic rule is that if we get a wide bar that's in the direction that we want to trade, and it closes in the top third if we want a bull put spread, or the bottom third if we're going for a bear call spread, then we place it below the wide bar. Okay, so I'm going to try and draw this. So if we look at this first wide bar that we see here, you'll see we've got a wide bar here, so that's unusual activity there. If we placed a credit spread here, then that would be safe. It wouldn't go down below the below where the bottom of the wide bar. So in that case, we're probably placing a 40-41 bull put spread. We see this wide bar here, top third of the bar. Again, we could place a 43, 44. Still quite a few cents. Again, you look at the, let's take the next trading. This wide bar here, we're in the lower third. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so if we look at the next 10 bars, it didn't actually close above the top of that wide bar. So if we'd have placed a bear call spread there, that would have been safe through to expiry. We could have placed again, here's the rule. If we were to place a bear call spread here, bottom third of the bar doesn't breach the top of that bar for the next 10 days. So that would have been safe. So what are we at now? We're at 4-0 in our favor. We look at this one. we wouldn't have entered it. Why? Because it's not closed in the top third. It's closed around about halfway on the bar. So we wouldn't be considering this as a reversal. However, if you were feeling, let's say there was a last 5 minute, let's say there was a last 5 minute price move which pushed it down a little bit, then we could have put a bull put spread here at, let's say, 38.39, and that still would have been okay. It didn't close below that Y bar. 6-0. Okay, next one. There we have another one. Now this is a pre-earnings. This is a pre-earnings trade, so we probably wouldn't have entered that one, but we would certainly have entered this one. Excuse me. We'd probably entered this one, maybe a 50, 52.50 bull put spread, and you can again see it didn't close below that wide bar. So 7 zip in our favor. Okay, now look, that was fortunate. As I said, I just picked up a chart just before we started because I like to keep it. I like to keep it live. But we've seen this time and time again, and what we Apple. This is from the last time I talked about this. So here we have one go against us. Just to prove it's not infallible, because no system is. So we had one against us. So as soon as it closes below that, above that wide bar, so we'd placed our bear call spread there. As soon as it had closed above that wide bar, we'd have cut it off. Okay, so our loss would have been relatively minimal, and certainly significantly less than if we'd let it run for the 2 weeks, which is, or try to roll it over, which is two bizarre strategies that credit spread traders use. Okay, above this, we've got here's another wide bar, there's the last third, there's our bear call spread, boom, there's another win. Okay, didn't close in the last third, so we wouldn't have entered a bear call on that, so that's still okay. We could have, if we'd been very brave, entered on this one, but we probably wouldn't have because of the way that day was towards the back end of August. And again, we could have looked at this one here. We could have placed a bear call spread there, last third of the bar, that's okay, didn't close above the bar again. So how many is that? That's about 10-1, okay, which is about what we're seeing. So in terms of win-loss ratio, which is vitally important with credit spreads, then this is a pretty powerful tool. And why we're calling it my favorite indicator. For credit spreads, there is nothing I've seen that is more reliable in my 20 years of trading, that is more reliable in terms of picking out those high probability trades which you need for credit spreads. So this was something that was new to us. We actually, so about 18 months ago, and so we traded it. We traded exactly this for 3 months and got our 18-to-2 win-loss ratio. And that's something that we've seen time and time and time again. Is that good? Do you like that? No, you don't have to have Hawkeye. As I said, for those of you moving forward, then I'm going to show you exactly how to do this using proprietary indicators. It's not complicated or hard, but you do need, it does require a little bit of explanation, which is obviously what some of you are going to do if you're keen enough on doing this. And really, if you're doing credit spreads, why wouldn't you investigate this? It's hard to get out of the way of the downdraft. You can get wiped out with one move. Look, that's one of the reasons why one of the rules is we don't actually enter. Well, first of all, you can only see a wide bar. Really, by the end of the day, that bar is fully complete. And secondly, why we don't, why it is the a last sort of half hour, last hour trade, and why we're very, very careful about the win-loss ratios. Okay, I'm just checking through. How much premium are you collecting on spreads? Great question. Look, it varies. Because we're placing the if we're entering something from a technical reason, you need to consider strike price placement based on the technical evidence, not just because you get a certain premium. So therefore, the premiums will alter depending on how far away from the action it is, what the underlying volatility is. But really, we would be reluctant to consider anything less than 10 cents. Obviously, we've got a margin requirement of $1 if we're putting our strike price is a dollar apart. So we're looking for 10 to 15 cents to make the trade viable once you've taken fees out of the equation. Just having a quick look through. No, it wasn't a lot higher, Michael, but good question. The loss on the two, they were, so we're looking to pull off 10 to 15%, bearing in mind our dollar investment. The average drawdown on a credit spread, if we exit, is around about 35%. So we hope to retain. The worst I think that we've seen is 55%, and that was the so that why win-loss with credit spreads you've got to, because when you do have a trade that goes against you, invariably the loss is bigger than the win. If you don't manage the exits well, then you need look, I've seen this time and time again where people have just had a go at credit spreads. They have 4 or 5 credit spreads which really work well for them, and then boom, they're gone in one trade because they don't manage the exit well, or because they've entered at the wrong time, or in wrong market conditions. So great point. Really glad you answered that. Asked that question. Is there a range of stock values that you look for that work best? I think I get your question, Terry, but let me try and answer. There's a couple of things when we have a look at with stocks with credit spreads. First of all, we want the underlying to be very liquid. So we choose the most liquid stocks on the market. Invariably, we would not be placing credit spreads. It'd be very rare to place a credit spread on something that was less than $20 a share. But really, really, it's the liquidity of the option, which is one of the crucial things. Because if you don't get a good fill in and you do have to exit and you get a poor fill out, then obviously that's never good, and your 10 to 15% can quite easily become premium that you bring in initially could quite easily become 5 or 6% if you enter in something that's got a wide bid-ask spread. There are other rules we would put in place, and make a note of these. Never enter a credit spread in the first half hour. Really, that's simply because it often takes that amount of time for the bid-ask spread to come in, particularly if you're placing at market. If you can trade it live, then do trade it live and get your best limit, fight it a little bit, see what you can get. So there's a couple of other rules of the game. Vin, great question. I've not tried broken wing butterflies on using wide bars. I have tried butterflies, just a straight butterfly with that, but I'm not. I've waited until when I've ever done that, it's following the rule that so if I saw a wide bar and then I would wait until the price had moved, or may set a butterfly, an out of the money butterfly up above the level of the above the top of the wide bar. So if it finished in the top third, so let me just, there isn't one on Apple because it's in the bottom third. Might do a put butterfly. So if it broke through the last, so this might be a good example. So if we saw this, we might put an out of the money put butterfly at say 115, 110, 105 for Apple. That would be a possible way we could use butterflies, and obviously that's how do we trade iron condors? To be honest, I don't trade iron condors very much. Really, iron condors, and I would prefer to butterfly to trade a range bound trade. This would be an ideal place to trade an iron condor when you see something in congestion like this. So in this case, we could put a sort of, if we're doing weekly options, we could maybe do a 120, 122 there, and maybe at the bottom end of the range we do a 105, 107, something like that. That would be probably how we would place an iron condor, but we would tend to wait for congestion in that with the butterflies. If we were to do a butterfly range bound trade on this, maybe 110, 115, 120. That would probably be where we put the legs. Occasionally, in some markets, I'll put out an out of the money butterfly if we see an uptrend. If the market's still a little uncertain, then it might be that that's worth doing now. Obviously, low cost. Just find the next resistance point and put your 3 legs under that. If you see a stock breakout, this obviously isn't a live Apple chart, as I said. Okay, so here's another one on T. That's a lot of questions there. Okay, so you get the idea. You don't have to use Hawkeye charting. Hawkeye charting makes it easy, but certainly for directional trading, using some volume spread analysis is crucial. Hawkeye gives you those tools, but we're not talking about Hawkeye today. What I want you to do, or what I want you to get, is what we've talked about today. I want you to get a handle on, for those of you new, a little handle on credit spreads. For those of you who've got some credit experience, some revision of that, and for all of you, an opportunity to see the wide bar, or the proprietary indicators that we use to mirror the wide bar. I want you to see that. I want you to get some information about matching strategy to market. And as I said, really, for really a pittance, I would say this is not optional information if you're trading credit spreads. There's a couple of other things I want to let you know about. There's one explosive strategy which nobody's teaching to me. It's one thing that I taught for a very limited amount of time, about 3 years ago. And here's the idea. So what if you were able to expose yourself to one-to-one movement as the underlying chain? It didn't cost you a penny, didn't cost you a bean, didn't cost you a cent, I guess, for most of you. Okay? So you've got an asset in place that mirrors the movement one-for-one. And then what if you bought some put protection underneath to cover the downside risk? So the only cost in this position is the cost of the put. And then, on top of that, you had the ability to sell weekly or monthly calls over the top. Okay? And this is what I'm calling for now, shares no money down. Now, if you are to do this, this is not for new traders. This is for people either who have got some experience or are willing to do some hard work. Okay? Because you must know, if you're going to be successful at this, how to do the correct setup, how to manage the risk, and how to manage the sold call so very, very well. Okay? So I'm going to do a little bit of a session on this as part of what we're going to sort of give you the opportunity to access today. So firstly, we're going to look at my favorite indicator course. Now, this is over 2 hours of learning. It's on demand, so you get immediate access. We're going to revise credit spread trading, as I've said. Avoid the 5 key mistakes with this strategy. Look at the Hawkeye wide bar with the common indicators, all the trading rules. We're going to look matching strategy to market and how you need to make this absolutely almost number one priority, I would say, for the next quarter in terms of adding to what you're doing with your trading now. We're going to talk about mastering exits because that's the most important thing in mastering your trading after strategy selection. And look, these principles are transferable across multiple vehicles and timeframes. So even if you're not trading options yet, or you're new to options, but you're trading other things, what we're going to cover here, you can transfer it across. It's really that easy. There's the link. Just don't mess around, guys. It's there for the taking. It's $97 only. It's almost a no-brainer in terms of what you're going to get for this. And as I said, on demand, you've got immediate access. Okay. For the next hour, those enrolling are going to get a chance to access the Hawkeye Options Trade Learn Portfolio Service. There'll be some instructions on that. And I'm going to give you the opportunity to personally connect with me after you've watched the course to answer any further questions. Now, here's the kicker. Recognizing that there are two types of traders on here. That there are those who are new to options. We're going to run a special 1-hour webinar called the Kickstart session, which is really for you guys, to enable you guys to really sort of hit the ground running, to learn to know exactly what you need to learn about options before you trade. And this is going to be useful to you guys who are just finding your feet or maybe even getting back on the saddle. The second thing, if you do have some experience or you're prepared to work your backside off to learn this, then I'm going to give you access to the Shares No Money Down session as well. So we're in 2 sessions over the next couple of weeks, and for those of you enrolling in the $97 course, the on-demand, which I've just talked about with all of those fantastic benefits, then I'm going to give you the opportunity to access both of these. And this will be recorded as well, so even if you can't make those sessions live, I will be making sure that the recording gets to you. So waste no time, get onto the link that you see there at hawkeyeoptions.com/thirsty, and then I'll see you on the other side with that. Really excited about this. It's as I said, it's something that I only with the extra strategy that we're putting in here, the information on that, it's something that I only taught for maybe 4 or 5 months. Then I took those small elite group of people through over the next sort of 4 or 5 months after that, just to make sure that they're okay with it. But there's something like 15 videos within that you've got to commit to doing if you're going to take advantage of that. So anyway, I'm here to answer your questions while you guys are busy enrolling. Those that are wanting to enroll, I'm recognizing that I've probably got about 5 minutes. Is that right, Jeanette? Before we're due to have the next speaker on, is that?
Yeah, it does. And hey, listen, the link that you gave to us was, I'm noticing now the link you gave to us was HawkeyeTraders.com/thirsty, not Hawkeye Options. I know you're really good at fixing things on the fly, so I'm going to let you fix that with your little PowerPoint mania over there. I typed it in, and then I was like, oh no, he must have changed it. And I tried to type yours, and it wasn't working. So it's Traders, y'all. Somebody's already posted that in the chat trying to buy HawkeyeTraders.com/thirsty. And I put it in the chat box for you guys, so you should be able to go to the chat box and just click it straight on instead of typing it. And okay, yeah, go ahead, Mike. You got about 5-7 minutes. Do your thing.
That's perfect. Okay, let's. There we go. As if by magic, the right link appears. So HawkeyeTraders.com/thirsty. Now, I'm just going to answer your questions. Okay. What broker do I recommend? Oh, look, I use Options Express simply because I think it's really user-friendly. A lot of the guys that I've coached use it because it's a really good platform to start on. Many of the guys use International Broker. The cost is cheap, not particularly used. Again, I don't prefer one that's right for you. First, the one that a lot of the Hawkeye guys use. Is the course for lessons, or does it include some of the Hawkeye indicators too? Hawkeye, just for clarity, is a plugin that you can access. And look, maybe on one of those webinars, I'll talk about Hawkeye in a bit more detail and give you access to, give you the opportunity to access something to get you started with Hawkeye. Or if anybody's interested in Hawkeye specifically, email me. I'll give you a link to the next Hawkeye webinar, which will give you all you need to know on Hawkeye.
Hey, do me a favor, Mike. Like everything you said over the past minute kind of got garbled, so just kind of like just do like a quick little recap for my recording.
Okay.
If you don't mind, it sounds clear right now, but all of a sudden you went underwater and then you came back up. So just do that for me.
Sure. There's quite a few questions on Hawkeye software. It is a plugin which works with a number of different platforms, and what I'll do for anybody moving forward is I'll put on I'll make sure that you know a little bit more about Hawkeye. If you are interested in Hawkeye, then if you just pop me a little email through, I will make sure that you get access to the next Hawkeye open trading room so you can have a look at Hawkeye in a bit more detail as well. But certainly those of you moving forward, you're going to get a little more exposure to that. But I think it's important that I show you with standard proprietary indicators as well, because recognizing that even if you do decide that at some stage Hawkeye is right for you, then it's going to take you a little bit of time just to get familiar with that. And I want you to learn this stuff and start to trade it in practice very, very soon. There's nothing like practicing something in the reality of even a demo account to get the handle on a particular strategy. Minimum account to start. Look, I know options traders who have started with 4,000 or 5,000. If somebody was asked to ask me what the ideal is, I would say it's not much more than that, maybe sort of 8,000 or 10,000 if you're new to options. You can trade with obviously less, but you don't want to be making decisions generally on the size of your account. Obviously, right, here's the bottom line. This is a really important piece of information, and this is to do with trading any vehicle. When trading any vehicle, it is not when you put some money into your account to start to trade. The idea there is to provide a weight of evidence that you can do this. Okay, so it really doesn't matter if you don't make a great stack of money. If you make, let's say, if you made 4% a month, okay, 3 or 4% a month, and that was what you did on a consistent basis with a really small account, that's fantastic, because now, and you managed to do that for, let's say you managed to do that for a year. How powerful would that be in terms of giving you the evidence that it's okay now to go and find some more money and put it into an account? The mistake that many new traders make is they gather around a chunk of cash, lob it into the market before they're used to trading. So for those of you starting out, and this includes those of you starting out with options, start with a bank that's not too scary. Build up the confidence, and then that will provide you with an awesome platform for trading for a lifetime, because it's not about trading for the next 6 months or trading for a year. It's about developing the skills, the knowledge, the confidence to trade for a lifetime. I'm really glad you asked that, Angie, because it gave me a chance to sort of say one of those things that's really important to me in terms of making sure that you guys are okay. There are specific rules relating to using Hawkeye with options, and again, those of you moving forward, particularly those of you who want to education on all the strategies about how to use Hawkeye with those basic
All right, Mike. It sounds like you've
okay, guys.
Totally
I think
in the water. There you go. Now you're back.
Oh, okay.
So whoever just asked that question, maybe they could email you the question so you could respond about the $10,000 account.
Perfect.
I think that's where we lost you.
Okay. Apologies for that, guys. I'm not sure what's going on. Maybe there's a storm around these parts. There's been a bit of there's been a couple of bushfires lately, so it might be that that's interrupted some stuff.
We're just gonna fly you over here, Mike. That's what we're gonna do. We're just gonna fly you over here in
Perfect.
Alabama. You're gonna speak from Alabama.
Excellent, excellent. I'm on
All
the
right.
plane.
All right. Well, thank you so much for coming tonight. Y'all give him a big round of applause. His link is hawkeyetraders.com/thirsty. And so we'd like to thank you, Mike. I know it's early over there, and we appreciate you getting up to do this for us.
You're very welcome. Take care, guys. Trade safe and learn with passion, because it always makes a difference. See you soon. Bye-bye.
All right, let's see if I can get the screen back up. Okay, that was Mr. Mike Smith of HawkeyeTraders.com. Speaking about volume analysis, his link is www.hawkeyetraders.com/thirsty. I'm sure in homage to TradeThirsty, so we appreciate that. We have one more speaker tonight. It's a great friend of mine. He's an Aussie who lives in Canada, who I first met in Las Vegas. So we've been around the world with this guy. He's a great guy. He got a great topic tonight. I've heard him give this presentation a couple of times. So his sound hopefully will keep us clean through the next hour. We have one more hour, and that is going to be spent with John Seville of Acorn Wealth. If you'll give me just 1 second, let me change out my recording.